If you are trying to buy a home and you don't have a huge down payment and maybe your credit isn't perfect, this is exactly the video you want to watch. Today I'm breaking down FHA loan requirements for 2026, and I'm also going to answer the questions I get literally every week. Things like qualifying credit scores, debt to income ratios, mortgage insurance, and what paperwork you actually need to get pre-approved. But first I need to clear up a really big misconception. FHA loans are not just for first-time home buyers. They are not only for people with low credit, and they're not only for people with tiny down payments. An FHA loan is simply a loan for someone buying a primary residence who meets the guidelines. That is it. I've seen repeat buyers use it, people relocating use it, and even buyers with good credit still choose it because sometimes it just makes sense. So naturally, the next question is, what are those guidelines? Let's start with the reason most people look at FHA in the first place, the down payment. FHA allows you to buy a home with as little as 3.5% down. So to put that into real numbers, a $100,000 purchase equals $3,500 down. $200,000 purchase equals $7,000 down, and a $300,000 purchase equals $10,500 down, and you get the idea. Now here's the part that really matters. The down payment depends on your credit score. If your credit score is 580 or higher, you can use the 3.5% down payment. If your credit score falls between 500 and 579, you can still qualify, but you will need 10% down instead. So let me show you what that actually looks like. If you're buying a $400,000 home and your credit score is above 580, your down payment would be $14,000. But if your score is below 580, now you're looking at a down payment of about $40,000. Same house, same loan type, just different credit score. Now here's a really important bonus a lot of buyers don't realize. Your down payment does not have to come only from your savings. It can come from your checking or savings account, a gift from a family member, or a down payment assistance program. A lot of buyers who think they need years to save up actually qualify much sooner than they expected. If your credit score is under 500, I do want to be upfront. Unfortunately, you will not qualify for an FHA loan right now. But I really want to pause and talk to you, especially if your score is somewhere below 580. Even if it's in the low 600s, I really think you should hold off on buying for a bit and focus on boosting that score first. The higher your score, the better your loan terms will be. You'll get a lower interest rate, you'll be able to afford a bigger home, and your monthly payment will just be easier. That credit score affects everything. So I'd much rather see you take the time to improve your score than rush into a home purchase with a really low number. And I know it can be tough, even though FHA guidelines say you can do it at 580. A lot of lenders will set their own higher bar. They might say, we need a 620. Because frankly, the lower the score, the bigger risk you seem to them. So if the lender says they don't do that loan, I'd really encourage you to shop around. Your bank or your credit union might not offer it, especially at those lower scores. You need a broker who really knows FHA and the ins and outs of those guidelines. If you're not sure where to start, I've actually got a link in the description where you can reach out to my team directly so we can help you get that process going. When most people think of FHA loans, they think of that low down payment and the flexible credit requirements because that's what you see everywhere, right? But one of the biggest perks of FHA beyond just the down payment and lower credit score flexibility is that it lets you qualify for a bigger home because you can have a higher debt to income ratio. Basically, that means you can have a bit more debt compared to your income and still qualify, more than you would with a conventional loan. Now, if you're thinking, wait, what even is debt to income ratio? No worries, it's just your total monthly debt payments divided by your gross monthly income. That's what lenders look at to decide how much house you can actually afford. So in this video, I am going to walk you through some quick calculations so you can get a sense of what you might qualify for. First, we need to figure out your gross monthly income. That is what you bring home before taxes. Now, if you're self-employed, this can get a bit tricky, so I do suggest you talk to a lender who can help you sort through that. Things like write-offs and depreciation make it a bit more complicated, but if you are a W-2 employee, meaning you get a regular paycheck, this is super simple. You just take your annual income and divide it by 12. Once you know that number, you can do some rough calculations and see if the home you're aiming for fits your budget. All right, let's say, for example, you make $100,000 a year. If you break that down, that is about $8,333 each month. So that's your gross monthly income. Now, we need to figure out how much debt you actually have, and this is a big one. Some people think debt includes things like groceries or date nights, but it doesn't. The lender is only looking at what is on your credit report. So that's credit cards, car loans, installment loans, basically any debt that's showing up on your credit card. And then the lender is also going to add in an estimated mortgage payment. When you're going through pre-approval, they'll give you a rough estimate based on the home price range you're looking at. Now, this is where the front-end ratio and the back-end ratio come in. The front-end ratio is all your housing costs, your mortgage, taxes, insurance, and any HOA fees. So let's say that total is $3,500 a month. You're going to take that $3,500 and divide it by your $8,333. So that's 0.42 or 42%. And here's the great part. FHA lets you go up to 47% on the front end. Then on your back end, you will add all your other debts. So if you got say $700 in other payments, now your total is $4,200. Divide that by $8,333 and you get 50%. FHA will let you go all the way up to 57% on the back end. Just reach out to my team and I've got that link in the description below. So we've talked about down payment, credit scores, and your debt to income ratio. Those are really the big three when it comes to qualifying for an FHA loan. But there's one thing that I know gets a lot of pushback, and I really want to address it, and this is mortgage insurance. Now, mortgage insurance has a bad reputation, I know, because people feel like they shouldn't have to pay it. But really, it's just part of how this works. It's what you pay when you can't put 20% down. And honestly, if you had 20% down, you probably wouldn't be using FHA in the first place. Mortgage insurance is there to protect the lender if something happens. If you don't make your payments and if you ever foreclose, that insurance covers them since you're a bigger risk with less money down or a lower credit score. So let's break down how it works. There are two parts to mortgage insurance. First, there's an upfront premium. It's 1.75% of your loan amount. And that's a hurdle a lot of people struggle with. So if you're buying a $350,000 home and you're doing that 3.5% down, your loan amount is going to be $337,750. That upfront mortgage insurance is then 1.75 of that. So it'd be $5,910. And that gets added right onto your loan, which means you're financing $343,660 instead of just the $337,750. So basically that initial cost eats into your equity right from the start. And a lot of people say, well, I don't want that because I'm losing my equity. But the other side is sometimes you just don't have another option. You might have to wait months or even years until you can save up a bigger down payment and skip that upfront cost. For a lot of my people though, FHA was just a stepping stone. They bought their home and they later refinanced out of it, built tons of equity, and it worked out really well. So it's not a bad thing. You just have to know what you're getting into. So I also want to talk about the monthly mortgage insurance premium. It's something everyone with an FHA loan has to pay if they don't put at least 20% down. And honestly, it's always there, no matter how much you put down. You'll have that monthly mortgage insurance plus the upfront one we talked about. Now, an example we use, when you put 3.5% down, your mortgage insurance ends up being about 0.55% of that base loan. So in that scenario, it's about $1,890 a year. And since you pay that monthly, it breaks down to about $157.50 a month. So that's extra on top of your mortgage, your property taxes, and your home insurance. And the big thing here is that when the lender is figuring out how much you can afford, they include all of these costs. Now, one big thing you need to know is that with FHA, this mortgage insurance stays for the life of the loan if you put only 3.5% down. A lot of people think that once you hit 20% equity, it falls off, but that is only with a conventional loan. With an FHA, it stays on unless you put at least 10% down, and even then, it will not drop off until after about 11 years. I mean, most people using FHA don't put that 10% down, so it stays on for the whole loan. But here is the silver lining. If rates drop or if your equity grows, you can always refinance into a conventional loan. And once you do, that mortgage insurance will go away. And this loan is really for anyone buying a primary home who meets the guidelines. It does have to be your main residence. People ask me all the time, how long do I have to live there? And yes, you can rent it out later, but you have to buy it as your own home first. So if you already own somewhere and you're trying to use FHA, it has to make sense, especially if it is your first home, since the lender will assume it's your primary. FHA can work for single family, homes, condos, even multiple unit properties up to 4 units, as long as you live in one. And that's one of the biggest perks, house hacking, if you will. But it's a bit tougher in high cost areas because you have to pass the self-sufficiency test in other parts of the country. Like the Midwest or the South, you can definitely find them. Just remember, the home has to meet FHA's property standards, no safety issues, no big structural problems, unless you're doing a special FHA 203K project. So just keep that in mind. If you are thinking about buying a fixer-upper, you might want to look into the FHA 203K loan. That will let you roll the cost of renovations right into your mortgage, while a standard FHA loan does not. Now, before we get into the documents that you will need, let's touch on loan limits. These change pretty much every year because they're based on the median home price across the country. When home prices go up, loan limits usually go up too. But if they stay flat or drop, the limits stay put. Your lender will be able to tell you exactly what they can lend based on current limits. Now, it really depends on where you live. If you're in a lower cost area, your FHA limit might be in the mid 500,000s range. But if you're in a high cost area, those limits can be over $1 million. And if you're looking at multi-unit properties, each additional unit raises that limit. I will link the current numbers below so you can check based on your area. If you're thinking his FHA loan could be a good fit, I just want you to pause for a second. Before we get into the paperwork, I want you to keep an open mind and make sure this is the right path for you. I encourage you to have your lender walk you through a side-by-side comparison of all the loan options that you qualify for. As you go through pre-approval, you'll want to see exactly what each program offers, your down payment, your closing costs, all of that, so you can make a smart choice. I often hear people go in thinking FHA is the only option when there could be a better fit. Or sometimes it's the opposite. You might think FHA is not for you, and then it ends up being the best deal. So keep an open mind. As part of that process, you'll need to get some key documents ready. You'll need your last 2 years of W-2s, or if you're self-employed, your tax returns for the last 2 years. You'll also need your most recent pay stubs and your last 2 months of bank statements. Both checking and savings so they can see where your down payment is coming from. And don't forget a government ID like driver's license or passport, because the lender needs that to verify your identity. And yes, they do have to pull your credit. I know some people worry that checking your credit will hurt your score, but as long as you do all your lender shopping within about 45 days, it only counts as one pull. And this is crucial. The lender needs that full picture, because without seeing your debt, they can't really tell what you can afford. Once they have all of that, they will give you a solid idea of your budget. Sometimes more than you expected, sometimes less. But either way, work with a pro. Don't just rely on random online searches or with your bank. Go with someone who really knows FHA loans. Click the link below and my team would love to help you. FHA loans are still one of the best tools out there, especially with rising prices or if you're working with a smaller down payment or credit challenges. So if this helped you, I hope you give me a thumbs up, subscribe to the channel, and drop any questions you have about FHA, and I will be sure to get back to you.